aptly put by the Nomura team. They are saying that the Goldilocks story continues for India. So let's try and talk more about that. Dr. Aurodeep Nandi joins us on the show. He's the India economist and vice president at Nomura. Aurodeep, hi. Thank you so much for making time and speaking with us. Talk to us about the Goldilocks story. What are you penciling in? How is it likely to pan out in FY24 going forward with respect to the GDP, with respect to the rate cuts?
So essentially, look, the term Goldilocks, and I don't know why people have settled on Goldilocks and not other Disney characters, but Goldilocks essentially means when your growth is good and your inflation is relatively low. And that's sort of the perfect situation which any economy could hold for. And the data that we've got since last night has sort of painted that picture. So we've got inflation coming in at much lower, at around 4.3%, and industrial production growth for the month of March, surprising market estimates at 4.2%. Now, in terms of where we see these variables going forward, inflation, we believe, is going to be lower. So we expect the average inflation in FY24 to be around 4.7%. This compares to the RBI's 5.1%. And even though there are upside risks on inflation, particularly from the food side, and we really don't know how the El Nino, the climatic risks are going to play out. But nevertheless, the factors that we see on the ground, which is very proactive supply side measures by the government, manufacturing costs coming off, the second round effects in terms of expectations, wage growth remaining relatively capped. So on the inflation front, I think we are going to be in a phase of lower inflation. It's on the growth side that we have a bit of a divergent view. I mean, the early data for Q2 of this calendar year seems to suggest that the momentum is there. But we think that the cycle is peaking off. And what we are concerned with is that in the second half of the year, the impact of this policy tightening that's happening so much globally will start to get more and more evident, and global growth will start slowing, which will then have an impact on exports, particularly also on the software export side, which has been driving a lot of the overall external sector, and on the investment side. Plus, within the consumption bracket, I mean, the GDP number that came out for the first quarter of the calendar year, or Q4 of FY23, India's GDP growth was 6.1%, but the consumption growth was less than 3%. So consumption is a matter of worry that has to be looked at. So overall, for India's GDP growth, we have a projection of 5.5% for FY24. So we acknowledge that we are below market consensus here, and below the RBI's projection of 6.5%. To answer finally your last point, which is what do you think the RBI will do? Well, I mean, again, we are out of consensus here. We expect rate cuts starting from October in the year, and 75 basis points in the second half of the fiscal year.
Right, Mr. Nandi, this is Vinny joining in the conversation as well. Obviously, you gave us a brief answer of most of the points that I wanted to cover as well. But I'm just going to ask you one thing. Now, obviously, India's GDP, that's obviously reached the 3.75 trillion mark in 2023. And obviously, when you look at it in just like almost a decade ago, 2014, it was the 2 trillion mark. From the 10th largest, we've become the 5th largest economy in the world. Surely there's growth. Yes, FY24, we may see a bit of those downside risks that you mentioned. But growth going forward, is that in place? Like FY25, would we be seeing better growth is what you are seeing now?
Yeah, look, I think there's a lot of good fundamentals that are there in place, right? We are having much cleaner balance sheets for corporates, also for banks. There is a lot of capex that is coming in from the government. There is a lot of reforms that have happened over the past few years whose effects are yet to play out. So I think there are a lot of positive fundamentals that are at play, but for these fundamentals to kind of kick in at a time when global growth is uncertain is a little difficult. So on FY25, I think we have a relatively rosier projection. We have around 6.5% or so. So it's more of a V shape that we have in mind currently. But this year, I think there are headwinds that one needs to be careful of.
Oh, well, yes, and one such headwind is the monsoon as well, right? We were talking just to SkyMet and they talked about how it's not about just delay in monsoon, but also the weak intensity. But Aurodeep, I know you are the subject matter expert when it comes to India economics. Can't say the same about US and global, but nonetheless, since we're getting you at the cusp of the FOMC meeting, any sense as to what we should expect with respect to the US CPI, the rate action from the US Fed?
So on the US inflation side, it might come out a little strong. So I think our US team has core CPI inflation at around 0.5% month on month. But we think that a lot of this higher print might be driven by temporary factors. So used vehicles and even within the sort of core services inflation, that is services X rent related components. We expect that a lot of it is going to be temporary factors. And while there is going to obviously be a natural temptation for the market, if the US inflation is higher, there will be expectations of more rate hikes. But we think our house view currently is that the Fed will look through these. So according to us, the US cycle has peaked. So we are not penciling in another rate hike in the upcoming policy meeting this week. So yeah, I mean, we think it's done, and now there will be rate cuts from March of 2024. But obviously a lot. There's a lot happening in the US with respect to what's going to happen for the banking sector, what's going to happen on inflation. So there's a lot of uncertainty there. But our baseline view is that higher, your core inflation this week might be a bit higher, but a lot of it is likely to be reflecting temporary factors. And as far as the Fed is concerned, our house view is that of a pause.
Okay, thank you so much for joining in with us this afternoon, Mr.